Welcome everybody to the Ellsworth Advisors December Economic and Portfolio Update. Happy New Year to everybody. I'm Kelly Keenan. This is Cameron Mealy. Today we're going to, as usual, start off with an economic update, kind of the latest numbers, projections moving forward into 21. I'll review the portfolios and then discuss a few of the hot topics that we're seeing right now. Cam, lead us off.
Sounds perfect. Thank you, Kelly. Happy New Year to everybody. Obviously, the fourth quarter just ended, 2020 just ended, so we don't have a lot of fresh economic data. I think the most meaningful information we've seen came out of the recent stimulus package. It also came out of the Federal Reserve. Their open market committee met on December 15th and 16th, and the Fed published their comments based on that meeting. And really, when we look at their comments, we're looking at their projections for 2021 and 2022. And if you look at GDP, gross domestic product, Federal Reserve is estimating GDP will grow 4.2% in 2021 and 3.2% in 2022. So pretty healthy growth compared to what we've seen historically. Obviously, with us still coming out of the COVID pandemic and vaccines still rolling out, a lot of that growth in 2021 is going to be in the second half of the year versus the first half. So we expect to see, a little bit of a sluggish economy in the first half of the year, ultimately starting to pick up. A lot of people believe come summer, we should be kind of fully reopened. We should have enough vaccines out there where the economy is back on track. So look for pretty strong growth in 2021, most of that coming in the back half.
Well, on that note, even fourth quarter this year definitely is not going to be as strong as what was projected.
Right.
What's the year-over-year projection?
The latest consensus I've seen for 20 is that GDP will be down 6.5%.
Okay, and we've been talking between down 3 and 5%.
3 and 5%, yeah.
And obviously the weakness in the fourth quarter wasn't anticipated with the resurgence of the pandemic. Definitely, slowed down, activity.
Yeah, I think we all thought at the end of the third quarter that, okay, we've learned how to manage this. We're making our way through it. And then
winter came.
Then winter came and flu season. And although we haven't seen any flu cases.
That's true.
So
That's true.
Amazing. If another thing to think about when we look at 2021 is continued stimulus. Obviously, it looks like Joe Biden is going to be president. It looks like the Senate now, based on the Georgia runoff, it's going to be a razor-thin margin, whether it's 51-49 or 50-50. It's going to be really tough for Biden to push any sort of what people might perceive as radical agenda through.
I agree 100%.
The Republicans will be stonewall in terms of their opposition to it. But I would certainly think that with a Democratic House, Democratic president, razor-thin Senate, we're going to see more stimulus.
Absolutely.
It doesn't matter if it's Republican or Democrat. I think politicians have learned that people love their stimulus.
Right, and we'll work with whatever they give us, bottom line. I don't think we're over-positioned in any one direction, and we know stimulus is definitely coming down the pipe.
Yep. So obviously it's going to add to the U.S. debt. I think their thoughts are that's an issue for later. Let the other guy worry about that. President Trump just signed a new stimulus package on December 27th. That was $900 billion. I wouldn't be surprised if we didn't see another $1 trillion to $2 trillion next year in some form of stimulus. So, that's going to continue to prop up the economy. And when the economy is propped up, and as we've talked about, there's no place to get yield right now. Interest rates are going to remain low, near zero. Those stimulus dollars that go in consumers' hands, they're going to be spent on, consumerism. They're going to be spent on goods. But a lot of that money is going to go into savings, and a lot of that money is going to go into the market.
Yep.
And ultimately, the market's almost a puppet right now being controlled by the U.S. government.
Right. And we're starting to see the inflationary pressures. Commodities are continuing to increase. Part of that is because of supply demand, the inflation, but also we're looking at a little weaker dollar. Mm-hmm. This morning, 10-year Treasury actually ticked over 1%. Which we haven't seen for 8 months or longer, or since last year at this time. Yeah. So, if anything, we've been positioning more for inflation with our gold position, our commodity position. That's definitely coming down the pipe, and that trend I don't think is going to reverse itself anytime soon.
Mm-hmm. And so we've got pretty strong growth in GDP. Obviously, that means people are getting back to work. The economy is opening up. So what does that mean for jobs next year and in 2022? This is according to the University of Michigan's research seminar Michigan does a lot of economic research, a lot of publications. Their football team is not very good, but
Wow.
from an economic standpoint, they're pretty strong. They're a trusted source. So this is from the University of Michigan. Sorry if there are any Michigan fans out there. About half of the 18.2 million jobs lost in the second quarter of 2020 should have returned by the end of the year. The economy should create another 3.9 million jobs in 2021 and 3.8 million the following year, eventually restoring most of the jobs lost by the end of 2022. That means unemployment nationwide will decline from an estimated 8.1% at the end of 2020 to 5.9% in 2021 and further improve to 5.3% in 2022. So if we get back to 5.3% in 2022, coming off of a global pandemic where we saw 18.2 million jobs lost, saw an economy virtually stalled, it's not bad.
Well, I mean,
and it shows the resiliency again.
Just the simple math of 2020 was minus 6%. It's going to be a good, till 2022, 23, until the economy is really again to where it was a year ago. That's really what we're talking about. So even though the snapback was quick in the markets, economically we got a ways to go.
We do have a ways to go. And so that takes us again to kind of the last piece of the stool, leg of the stool, is interest rates. Now, the Federal Reserve has already come out and signaled that they will not be doing anything with interest rates in 2021. Most economists expect that once we get to 2022, we could be looking at a 50 to 100 basis point increase in the federal funds rate. That still takes us nowhere near a historical average. But to your point earlier, we're already seeing a tick up in commodity prices, real estate, fine art, luxury goods. I mean, it really does seem like, especially in the high end, prices are starting to increase. I also saw that, Saudi Arabia and OPEC have decided to hold oil production. Actually, Saudi Arabia is going to be making some cuts, so we should see some inflationary pressure on the petroleum side. So, we haven't seen inflation in a long time, but it's out there, and we've got to be prepared for it.
It's coming. On the interest rate side, the Fed, they only control the short end, and what's going to happen is we've been in a situation the last couple of years where the difference between short-term rates and long-term rates hasn't been that great, and what's happening is you're having what they call a curve steepening, where the long end rates or your longer term rates are starting to creep up, even though the Fed's going to be holding down those short term rates. So that'll be interesting to see. Will the Fed succumb to the rest of the bond market, or they control the short end, everything else just keeps on stepping up? That's going to be an interesting dynamic. And it also affects where we're positioning in bonds. We've been, with our bond holdings, we've stayed on the short end, because when interest rates go up, that means your bond prices come down. And now bonds that are of a longer maturity, longer duration,
they're going to get hammered.
They're going to get hurt when rates start creeping up. The fact that we're really on the short end, that's going to give us the ability where as rates go up, we can start going out further, get the higher rates without getting the downside of the price.
Let's short stuff roll off,
the price
invest
is going
longer.
Down.
Roll off, invest longer.
That's our tactic right now, and we haven't made a whole lot in bonds, but the reality is we're positioned so that we're not going to get hurt there also as we go into this year and next year. All right, let's talk about our portfolios. It was a interesting year. December was a pretty strong month. Kind of going down the line, growth with income portfolio, really our balanced portfolio where we have both stock exposure, bond exposure. We have our gold exposure in there. In December, growth with income was up 3.75%. For the year, up 15.25, so a pretty good year out of growth with income, even though it's not 100% stocks. It really fared the best besides our small cap portfolio in our most widely held portfolios that we're using. Big winners of the year: NVIDIA up 122%, Apple up 82%, Nike up 41%. Our losers for the year: CVS down 5%, Cisco down 3.5%. Verizon down 0.12%. In December, Disney was up 22%, Apple up 11.5%, J&J up 8.78%. Losers in December, NVIDIA actually gave up 2.56%, but after 122%, we're not going to complain about that. Verizon down 2.75%. So Verizon kind of had a rough year there. Dividend yield. These are really our defensive stocks, higher dividend payers. Really a disappointing year for dividend yield. But once again, the market really was made up of two factions. You had your handful of your call it stay-at-home stocks, your tech stocks that drove the overall index numbers, but they really are only 5 or 6 stocks created a lot of that performance. And
yeah, they're not indicative of the market.
They're not indicative of the market, and also you start looking at their pricing, and the pricing is kind of scary in how these things are priced right now. They got through the pandemic well. They grew their earnings, but the reality is now I believe they're way ahead of themselves, and it's a dynamic that keeps on bringing me back to bad memories of the late 90s, 1999, 2000. So, dividend yield, we're not exposed to those companies, so we didn't get the upside of them. But in December, dividend yield up 1.1%. For the year, only 4.5%. And of that 4.5%, probably 3 of it was dividend yield. The reality in fourth quarter, that portfolio was up 8.14%. So it made up a lot of ground. We are seeing rotation into more of those quality, your more defensive type stocks. And I think that trend is going to continue. Some people call them value stocks. We're going to continue to stick with that strategy because we are looking for dividends, we are looking for stability, and that's really what this portfolio offers. During the year, we did have some big winners in there. UPS up 48%. No surprise, little increase in deliveries this year. Eaton Corp up 31%, Caterpillar up 27%, and Blackstone up 20%. So some good winners in the portfolio. Obviously, we had some losers since we were only up 4.5%. AT&T down 21%. Obviously, that looks pretty good going into this year because there's actually a lot of good things going on at AT&T. Con Ed down 16.7%, Prudential down 11%. Going to our price potential portfolio, once again, our growth-oriented portfolio, but the reality is growth with a real eye towards fundamentals and quality balance sheet. So once again, price potential, we lagged the index. Year to date, we're only up 5.5%. December, we did pick up 4.06%. For the quarter, 6.55. So we're seeing some acceleration at the end of the year in price potential. Our year-to-date winners, and these are really all these stocks. Most of these were all bought prior to throughout the year. Edwards Life, so they're not even held for a whole year. Edwards Life Sciences up 25%. Mantech International up 31%. Aflac up 23%, Progressive up 23%, Republic Services up 20%. So some good winners there. Losers of the year, Allstate down 0.12, Genpact down 0.92, and Lockheed Martin down 6. So, just not big losers. Had some decent winners, but a whole lot of in between. Not a lot of churning around inside price potential this year. The exciting portfolio this year was really our small mid-cap portfolio. December, our mid portfolio was up by 9.75%. For the quarter, up 31%. Year to date, the portfolio did about 30%. So, great run towards the end of the year with small caps. I think we talked about it last month, where once again, in searching for better pricing, you look at the S&P 500, which is large company stocks. That's been so picked over, so overbought that now investors are looking towards smaller company stocks where the pricing is much better, and we've definitely seen things run in the small cap arena.
You definitely saw that rotation because in the first half of the year, we were talking about small caps weren't moving at all.
Exactly.
There was no excitement around them.
And they got hammered pretty hard, in March, along with everybody else, but maybe even more so. This is where some of the crazy numbers come. Year-to-date winners, Tech Target up 126%, Ameresco up 198%, Appian up 324%. Our losers for the year, CBIZ down 1.3%, and First Capital down 10%. So, kind of gives you an idea. the big swings in that portfolio. We do hold 40 stocks to help temper the swings, but once again, we're seeing some good things happen in small cap, and there should be a continuation in small cap for I think for at least for a little while till the bubble bursts, so to speak. So that's really how the portfolios did. From a market standpoint, we'll see a little bit of divergence here. So the Dow Jones up 9.7%. S&P for the year up 18.4%. And once again, in the Dow you do have Apple in there, so that definitely brought those numbers up. In the S&P, here you have the FANG stocks, where
but the Dow
my biggest concerns are.
The Dow might have been flat without Apple.
I think it would have been up 5 or 6%.
Okay,
it would have been all right. Even the equal weight S&P was really only up about 8 or 9%. When you equalize everything, you take out the big stocks, that brings the numbers down that much more. And from what happened in December, the Dow was only up 3.27, S&P 3.7 or 3.71. So once again, we're kind of seeing that rotation, and nothing really lines up to the calendar. I think we've already started seeing that happen later in the year, and that's a trend that's going to continue. We're not in a part of the market, and I'm not comfortable swinging for the fences right now, just having seen these dynamics play out in the past. And we are definitely, when you look at historical numbers, valuations, we're beyond 2 standard deviations of normalcy. And we're seeing, once again, we're seeing numbers we haven't seen, and the dynamics that we haven't seen since the late 90s. Now, could this persist for a lot longer? Absolutely. Could it go 6 months, 12 months, 24 months? Absolutely. But then again, it could only last 3 weeks. Who knows? So, we have to be fairly cautious with the key is surviving through any kind of major downdraft and being in a good position, if we do see a day of reckoning from a valuation standpoint. So that's kind of where we're at.
Okay. Kelly, there's one question I wanted to ask, and I think this has been on everybody's mind. It's been well publicized, and that's about cryptocurrencies. So according to Coinbase, which is one of the large exchanges, Bitcoin, which is really the headline cryptocurrency, the most popular or most well-known crypto in the world, was up 116% in the fourth quarter. Now, people are talking about this could be wild speculation. This could be as a hedge against a lower dollar. Will there be, what are your thoughts on cryptocurrencies? Will there be a standardized currency, a global recognized currency in the future? Can we identify it today? Can we pick winners out of the thousands of cryptocurrencies that are out there? What do you think about the market as Ellsworth Advisors Chief Investment Officer?
So Bitcoin, obviously it's been around several years now. We kind of saw a couple of years ago the boom and bust, and now it's getting hot again. And the reality I'm just going to call it Bitcoin, and they all basically work the same. But the one problem with them, or the reason we're not using them at this point in clients' portfolios, there's really nothing there, meaning, there's scarcity, and that's about it. There's no regulation around it. There are no standardized ways of trading it or regulation around, from a security standpoint, a tracking standpoint. And
there are no public filings or no K1s.
How do you value it? When you value a company, you're looking at, okay, this company's making profits, they have cash flow, there's future growth in the business itself. Okay, now you can put a valuation on it. Bitcoin, there's no business. There's nothing. It's an algorithm that says, there's only X number out there, and okay, so it's supposed to be worth something. I'm not real comfortable investing in something like that. And that's where the catch is. The history is so short. Now, you mentioned from a hedge standpoint, typically you look at a hedge as something that if things go bad in one area, that should do well. And to call Bitcoin a hedge against the equity market, that's hard to say when back in March, when the equity market got crushed because of the COVID, Bitcoin got crushed too. So, okay, well, it looks like a risk asset to me. So, maybe it gives you more juice to the upside, but it also means it's going to get slammed to the downside. So you can't really look at it as a investment hedge because it doesn't necessarily move different than the market itself. From an inflation hedge standpoint, and this is where maybe the arguments are stronger. Is it a complement to gold, or is it a replacement or a competition to gold in an inflationary environment? It could be. Now, once again, the history is short because we've never been through an inflationary environment while Bitcoin's been around versus we have with gold. So maybe it is. That is one theory that's out there is, okay, in a weakening dollar or an inflationary environment, Bitcoin will be an alternative to gold, which it could be. And that's the thing. I mean, gold and silver, those precious metals, kind of, that's the purpose they typically serve. Will this be now another competitor for some of those dollars that are trying to, search out that type of inflation hedge or dollar hedge? It very well could be. But once again, the history is so short. Gold has a thousands of year history. We kind of know what to expect there. That's what we've used in the portfolios. One, we can easily trade it through ETFs, or people can buy it physically, and there is a historical, decently regulated market to buy and sell silver. On the Bitcoin, there's a lot of question marks out there, and even from a regulatory standpoint, as RIAs, there's the regs on it, and nobody really knows what the impacts would be as if I were to buy it for clients. A lot of gray areas there, and hey, if I can buy gold, I might as well use gold in this situation. Just with Bitcoin, I just am not comfortable with it because there are no true and tried ways to really, once again, value it, trade it. It's the Wild West.
Well, and as a repository too, you're trusting somebody else as a third-party repository that's not regulated by the Securities and Exchange Commission or by FINRA. It's all these independent exchanges that are set up that you're trusting them to hold your Bitcoin and make sure it's secure. I think my problems that I have with it, same as you've talked about, is it's unregulated. It is still very much the Wild, Wild West. You see huge swings on a daily basis. There's a lot of speculation in there. And, I look at it, there's thousands of cryptocurrencies out there today.
Right.
What gives me the ability to predict or project who's going to be the 1 or 2 or 3 or 4 global standards 10 years from now?
Exactly.
And, I think my biggest concern, frankly, is you could have the U.S. central bank step up and say, we are going to issue our own cryptocurrency. It's going to be the new digital dollar, and it will be accepted at all U.S. financial institutions. It'll be accepted as the new monetary currency. All of a sudden, all those other cryptos are worth nothing.
Yeah, I mean, I think we're inevitably going towards a digital type currency, and whether it's one that's really being controlled or in the hands of a central bank or not, that's really what it's all about. I mean, obviously there's no, gold's not controlled by anybody, but then again, it is priced in dollars, euros, yuan, whatever we want to call it. The same thing's going to be of a central bank issued cryptocurrency.
Yeah, I don't see the G8 or G20 allowing somebody else, a guy who invented this in his basement, to all of a sudden have the standardized world currency.
No.
They're going to want their pound of flesh. They're going to want to be a part of it. They're going to want to regulate it. They're going to want to control it.
Central banks always say, the banking cartel has always had that control, and they will give you a sense of maybe somebody else has control, but they don't, and that's never going to be given up.
So,
not in my lifetime.
If you like to speculate, if you want to have a little bit of fun, have your little side account where you can put some dollars into cryptocurrencies, have fun with it. But we just don't see it as a true investment asset class right now. And as registered investment advisors, we're not comfortable holding it for clients.
Yeah, it won't be something I'll be putting in portfolios anytime soon. Not that I could see. So, other than that, it's going to be a rocky year. Elections in Georgia, it's going to be a split Senate, maybe a little bit leaning towards the Democratic side of the equation. I think a lot of the politics it's good. The country is still polarized, still divided. Perhaps some of the rhetoric will die down. I don't think with the results of where we're at today are going to result in any kind of extraordinary changes.
Yeah.
It's always, as always, it's going to be changes at the margins. We've gone through these things every single election. I don't think we're in any worse condition or in any more adverse condition than we've seen in the past. The U.S. will get through it. It's not, it's nothing it's nothing new. Life will go on.
Life will go on.
Comes down to, in our world, hey, trying to find businesses that are making money and, buying them at decent prices and participating in the gains.
Absolutely.
So I think that wraps it up for today. Thanks for joining us today, and welcome to 2021.
And we'll be back next month with another update. In the meantime, if you have any questions, please feel free to contact us. Thank you again for your trust, and Happy New Year.